Welcome to the show. This is G.K Show, and this is the first episode. Previously, we made an introductory episode, and this first episode, we start by thanking all our subscribers on Curiosity TV. Thank you very much. You are wonderful people. So today, being the first episode, we will focus on the basics, and we will start with the definitions of the common phrases used in public policy, in this case public finance. There are 10 main phrases or main words which are used in this public policy. The first one is program-based budget. And on program-based budget, Wikipedia describes it as practice of developing budgets based on the relationship between program funding levels and expected results from that program. So program-based budget basically is a budget which shows the various programs which will be funded by a certain budget, and then it also shows the results, what do we expect out of the program. That is why they have key performance indicators, and those things we will look at them later on and why they are important in your life as viewers. The second one is line item budget. Line item budget is the opposite of program-based budget. In the line item budget, the government provides a budget which is aggregated. There is budgets for departments or budgets for mostly departments, and according to the accountingtools.com, a line item budget is a form of budget presentation that clusters proposed expenses by department. So you have aggregates. Aggregates means you have totals of particular departments. The difference between line item budget and program-based budget is that for program-based budget, under each department there are several programs. There can be 2, 1 or 3 programs or more, and each program you are told the amount which will be spent on that program, and then there is sub-programs. Sub-programs is now, for example, if you have a program A, then sub-programs is now the subdivision of that program. The third phrase which is used in public policy is financial year. In America they call it fiscal year, and this is the period. In Kenya it's a period from 1st July to 30th June every year. A financial year is different from the calendar year. Calendar year starts from January to December. So this is an accounting period which covers 12 months. That's the financial year. Item number 4 is contingency fund. Contingency fund is an urgent or unforeseen expense or expenditure which is made from this fund. It is like emergency fund. Even you in your household or in your homes, sometimes you have some money set aside for emergency. This is money which you can easily access. It must be liquid money, something you can easily convert to cash. Or, better still, it should be cash money, which you have stored somewhere, maybe in the bank account, ready to be used when there is an emergency. Even the government uses the same principle. They have a contingency fund or an emergency fund. Phrase number 5, which is commonly used in public finance, is a consolidated fund. And the consolidated fund is a national government account which is kept at the Central Bank of Kenya, which facilitates payment into or out of on behalf of the government or national government. So if money is collected, for example, from income tax, this money must be deposited in the consolidated fund. If the national government wants to pay its debtors, its creditors, those people to whom it owes money. For example, Kenya owes money to China. When Kenya is paying money to China, they pay from the consolidated fund. This is an account kept at the Central Bank of Kenya. All the money which is meant for government is deposited into that account. For the government to withdraw money from the account at the Central Bank, they need permission. They need to seek approval for withdrawal from the Office of the Control of Budget, and that is now the consolidated fund. Now you understand that. The phrase number 6 is capital expenditure, also known as development expenditure. What is this? This is the expenditure for creation or renewal of assets. And normally it is expenditure on assets. For example, if the government buys a piece of land, that is capital expenditure. If the government purchases a motor vehicle, that's capital expenditure. But if the government pays salaries and wages, that is recurrent expenditure, which we will look on later on. Appropriation. What's appropriation? That is item number 7. The phrase appropriation means, according to the Public Finance Management Act 2012, it means authority granted by Parliament or County Assembly to pay money out of any public fund. This is authority given by the National Assembly or County Assembly. And that's why most of the time when the executive comes up with a budget, they have to submit it to the National Assembly if it's at the national level, or the County Assembly if it's at the county level, to ensure that the use of the monies is given approval by the Assembly or the national government, the National Assembly or the County Assembly. This is very important. The government at the 8th level cannot spend any money without seeking approval from the relevant assembly. We have budget policy statement. A budget policy statement is a policy document which is produced by the executive at the national level of government in Kenya. It is submitted to the National Assembly for approval. It contains the following things. 1, it contains macroeconomic forecasts. These are big words, but macro means aggregate or at the bigger level. When you are looking at something from a national level, for example, the total figures, for example, of the GDP, that's macro. But when you are looking at the profit made by maybe one farm or one company, that is micro. So macro and micro should not confuse you. Those are just big terms which refers to something which you already know. So they also contain hearings for the sectors, various sectors. There are various sectors at the national level: the health sector, education sector. There is infrastructure or roads, transport. All those sectors, the hearings are set at the level when the national government is coming up with the budget policy statement. And they determine or they decide how much they want to spend on, for example, health, how much they want to spend, for example, on education. That decision is made at that level. Then they also contain the financial outlook. That is, what do we expect in terms of revenue collection? What do we expect in terms of expenditure by the national government? What do we expect about what we call deficit, budget deficit, that's like a hole in a budget. You want to spend more than what you are going to correct. So what happens mostly when there is a budget deficit, it is filled by borrowing from bilateral partners. And bilateral partners, in this case, I mean borrowing from other countries, or multilateral partners like World Bank, IMF, and others. That is how we fill the hole left by budget deficit. Then number 9, we have local revenue. Local revenue is a term which is used at the county level to refer to the revenue that the county governments collect from their people at their level, at the county level. You know, national government collects some form of revenue in terms of taxation, like corporate tax, which is levied on companies. They also collect tax from income tax, import and export, excise duty, and many others. But also counties have a duty to collect revenue from some special sources which are indicated in the 4th schedule, such as rates, like land rates. They collect money from cess, from single business permits, and others. So those kind of things, we call them local revenue or own revenue. So with the final one, the final phrase which is used in public policy or public finance is recurrent expenditure, which we have already tackled, but briefly. This is expenditure which is ongoing on items such as travel, salaries, and operations. So if you purchase fuel for a car which is being used by the county government or the national government, then that is recurrent expenditure. If you spend on salaries and wages of the people who work for the national government or county government, that is still recurrent expenditure. So there are two types of expenditure. Either it is capital or recurrent. Capital or recurrent expenditure. So thank you very much up to that point. That is the first episode of Geoffrey Kerosi's show. Thank you for tuning in to Kerosi TV. After coming to an end, now watch out for episode 2, where we will be discussing about the big four agenda of the national government. You know, our president Uhuru Kenyatta wants to leave a legacy. What does he want to do in the next 4 years up to 2022? That will be our discussion. We will also see what other people are saying about the big four agenda. Thank you very much. See you in that episode. Thank you.